G'day and welcome to the Investor Motivation Podcast. My name is Robert Gowdy and joining me is Amy.
Hello everybody.
How are you, Amy?
Good. How are you?
Good. We've been busy.
What's new though?
Yeah, different types of busy. We're not wearing the busy badge. There's just been a lot on.
Yeah.
We've had a lot of end of year tax planning, particularly for a lot of the capital gains that are going to be realised into next financial year. We've brought some of them forward.
Yeah.
And we're thinking about the Altium transaction where we had a lot of exposure to that for our clients over many years. So we've been really focusing and honing in on the clients that have had substantial capital gains in their individual names where they're exposed to their marginal tax rate.
Yeah.
Where the income goes up, so does the tax rate.
Yeah.
And we're doing different tax management for those in the company or in a self-managed super fund.
Yeah.
Or superannuation in general.
Thinking about it now, we probably could have and should have done a podcast on that.
That topic alone, absolutely. Yeah. But let's cover off, because what we're doing today is we're chatting about end of year financial planning.
Yes.
So a lot of this will centre around superannuation, and we'll cover off on why super is important, and we'll be really reading off a presentation that I'm going to do next week, do a webinar, but we'll run through why superannuation important and why is end of year financial, I suppose, strategy planning really important.
Yeah, so this will be a bit more of a broader everyday kind of tax wins that we can have, more so than the capital gains situations where we're specifically trying to reduce capital gains liabilities.
Yeah, but we can go through the example, what we're doing at the moment, and give people a bit of a feel for how it translates into the real world. Yep. So before we kick off on that, if you can do the acknowledgement of land.
Of course. On behalf of the Investor Motivation Podcast, we would like to pay our respects to the traditional owners of the land on which we do record this podcast, and pay our respects to elders past, present and emerging.
Awesome. Thanks, Amy. Now, probably the first thing that we need to consider is why superannuation important.
It's the best.
It's the best. We get really excited by that.
It is. When we're looking at superannuation, we're really looking at a structure that we can invest in. And this main purpose of superannuation is to accumulate savings throughout our working life so that we aren't reliant on the age pension when we hit retirement. So hopefully there's a bit of a nest egg that's built up along our working life so that we have something to fall back on and stop working and spend that money that we've saved our whole lives. But the government have really made that an attractive nest egg and attractive to contribute to by making it the best tax environment, the best tax structure that we can possibly get in the world. Okay,
I love that word that you've used, tax structure.
Yeah.
Because when the markets turn bad, they correct or there's a crash, which will happen plenty of times ahead of us, superannuation cops a bad rap. They say investing in superannuation is bad, but let's not see superannuation as an investment. It is a tax structure, a concessionally taxed tax structure.
Yep.
How you invest within superannuation is really up to the individual.
Exactly right. You can invest the same in super as you would in your own name, especially true with self-managed super funds. There's a lot more flexibility of what you can and cannot invest in there. But yeah, it's essentially an entity, much like a person, but just in a great tax environment.
Cool. And a good example is that where we've had some clients that pretty wary about the share markets, given they've gone up by so much, they're probably not wanting to commit to the markets at this point in time.
Yep.
And that money, which is a large lump sum, is sitting in a big range of term deposits and fixed interest investments. So the chances of that money going down is zero for the term deposits, and come with a beautiful government guarantee up to $250,000 per institution. So that just shows that superannuation, as you've said, is a tax structure. It's not an investment. You invest within the tax structure into the investments that suit you based on knowledge, education, guidance from financial advisor or whoever you're dealing with.
Yeah.
So I think that's a really important point, because when markets turn bad, superannuation as a whole cops a bad name.
Yeah, it does. There's always those headlines. The market crashes, $30 billion lost in super. But it's lost everywhere. It's lost in the markets. Fantastic.
So let's cover off on some of the key points in terms of tell us about the tax structure. Why is it important?
Yep. So like I said, best tax structure that you could ever get. When you are working throughout life, your super will be in called accumulation phase because it's accumulating money while you're working. So while you're in that accumulation phase, it's taxed at 15% rather than your marginal tax rate, which is most commonly that 42%.
Yep.
So it's just an easy
32% or 42?
32%.
32%, and that's next year's with the phase 3 tax rates coming out.
Yeah.
Yep. So contributing to superannuation via concessional contribution, which is a pre-tax.
Yeah.
That money goes into super at 15%.
Yep.
Yep. If you're earning less than $250,000 per year, there's an extra 15% there are people that are above that.
Yep.
But that is a guaranteed saving of 17% per year.
Yeah.
And the income that's earned within super is also taxed at
15%.
Cool. And capital gains, once the asset is owned for more than 12 months, that comes with a third discount and taxed at 10%.
10%, yeah.
So, and once people get into, I suppose, retirement age, and they can, at this stage, so they get to retirement above preservation age, which is age 60. They can move across from a accumulation phase where we're just building up the money into a superannuation pension, and we can do that with how much?
Up to $1.9 million this year.
Cool. And that is taxed at how much within the fund?
0%.
0%. So $1.9 million, 0% within the fund,
Yeah.
and the pension that's paid out.
0%.
So again, 0, and this is the point. There is no better tax rate that we can find, and Amy's just doing the numbers.
If you are having $1.9 million, you've got all of that super pension cap, and you've filled it with $1.9 million at a 0% tax environment, simply in a 5% term deposit, you're getting $95,000 a year, tax free.
Tax free, fantastic. And this can be a husband and a wife.
Yeah.
Which gets you to $3.8 million that is tax
$200,000 a
free.
year, yeah.
So yes, there is constant changes from the government with regards to superannuation, and they're tinkering with it all the time. But there is still going to be that core carrot, that core incentive for people to go into superannuation, and for it to be, the mainstay and the core for their retirement.
Yep, 100%.
Yep. So don't ignore it. Yes, be wary of government changes. Know that they will happen, but the core benefit to save is still going to be there longer term.
Yeah, and I'm inclined to believe that the government are going to still keep it more favourable than simply investing in our own names, because it is there so that we're not relying on the age pension, so that taxpayers aren't funding retired people. They've built up their own savings, so
Yes.
they definitely have an incentive to keep super attractive and what people contribute to then live in retirement.
Yeah. Now there are limits on how much we can put into superannuation each year and get this 15% instead of paying tax at our marginal tax rates. So for the year that we're currently in, Amy, how much is that of concessional contributions?
Concessional this year is $27,500, and that is made up of your employer contributions. So currently employers are required to put in 11% of your salary. So then 11%, whatever's left over, is what you can contribute pre-tax, which is where you get that awesome, 17% tax saving if you're that middle bracket.
Yeah, and if you go over, and obviously just looking at some of the numbers now, once you get over 135,000, then all of a sudden you're in the 37 plus Medicare, which is 39%, and that's where you'd save 24%.
Yeah.
So the more you earn, the more that you save by utilising your superannuation strategy.
Yeah.
So what you can do if you have the spare cash, you say you're an employee, and you've got 10 grand go into superannuation, it leaves you with an extra $17,500 that you can put in as a lump sum, as a personal contribution. And if your tax accountant says, hey, it'd be really handy if you could put that money in and then claim that as a deduction, that will bring your income tax down for the year and mean you only pay 15 cents on that money.
Yeah. It's just the easy, what do we call it? The low-hanging fruit.
It's the low-hanging fruit. It's the easy wins. Next year, the concessional contribution limit goes from that $27,500 up to $30,000.
Yep.
So one thing that people should think about doing is, one, getting some money in well prior to the end of the financial year. The money needs to be physically in the account, not just on its way.
Yeah.
Now, gone are the days where people would bring in checks into our office, so no one's posting anything anymore. But a B pay on the Saturday before, I think the 30 June lands on Sunday.
Yeah.
I think a B pay on Saturday will more than likely not be in the account, and therefore you won't get the deduction. So I would be doing this stuff, days, months earlier.
Yeah, please. And if you are a client that listens to the podcast and you're thinking about doing this, let us know now, because of course we want the money to go in there, so we will try as hard as we can to make it happen, but it's very stressful for everybody involved.
Yeah.
So reach out earlier and we'll get it done.
Yeah, take pressure off.
Yeah.
Now, obviously we have those concessional caps, but there's some rules around the caps that you didn't use in the past. Amy, you can explain that one, please.
Okay, so if your super balance is under $500,000, you are eligible to use the carry forward concessional rule, which allows you to carry forward any unused concessional cap from the past 5 financial years, which is especially important and useful when, for example, with our LTM clients that are having a really large capital gain in next financial year, we can next financial year use that carry forward all the unused caps from previous years to reduce that capital gain amount.
In that year.
Yep, in that year.
Yep. And obviously, the main rule there is that your super balance must be below $500,000 on the June 30, the year prior.
Yep.
So, why would you do that? Well, capital gains is ideal, and also higher income earners.
Yeah.
Once it's gone, it's gone. Once you're above 500 grand, you don't get that option anymore.
Yeah.
Very good. Now, non-concessional contributions. What are they? These are funny terms: concessional, non-concessional.
Well, the concession is really a tax concession. So when you think about the concessional contributions, it's because it's only taxed at 15% rather than marginal tax rates. So it's concessionally taxed. It's taxed at a lower rate.
Yep.
So the non-concessional contributions means there's no tax benefit. There's no tax concession with these contributions in non-concessional contributions.
So it's sort of using your after-tax money.
Yes.
You've already paid tax at your marginal tax rate, and then you're putting it to superannuation.
Yep, and it won't be taxed on the way into super.
Yep.
So
So no 15% taken out?
No, but you have paid your marginal tax rate on it already. So.
Cool. Now, are there limits on this one, Amy?
Yes, this financial year we've got $110,000 available to us. So similar to the carry forward with the concessional, you can also trigger what's called the non-concessional bring forward.
Yep.
I know, very confusing. Carry forward concessional, bring forward non-concessional. That's what goes on in my head.
Okay.
So the bring forward non-concessional allows you to get the next 2 years of that concessional cap into the financial year.
Okay.
And it is based on the financial year that you are in's cap. So, for example, this financial year, that cap was $110,000. If I triggered bring forward this financial year, I could bring forward $330,000. But if I wait until next financial year, when the non-concessional cap increases to the to $120,000, then I can trigger it and bring forward $360,000, which is an extra $30,000.
Cool. So time to think a little bit more four-dimensionally, that if you've got significant, I suppose, assets outside of super that are now causing a tax problem, you'd put in 110 this financial year.
Yep.
So in June, and then in July you could put in 360.
Yeah.
And all of a sudden you've got 470 grand,
Yep.
nearly $500,000 that was earning money and potentially causing a tax problem.
Yeah.
At your marginal tax rate, going into super at either 15% or, if in pension mode, 0%.
Yeah.
Fantastic. So that's the non-concessional contributions, and I think we've sort of probably covered off why that's important. Even simple term deposits that were getting 0.4% when interest rates were at historical record lows, are now getting 4 and 5%.
Yeah.
So you can imagine that $500,000 example that I just provided. That could be bringing in an extra, good amount of money.
Yeah, heaps.
Yeah, heaps. So it could be,
Stacks.
that could be another, say $25,000 that would go on top of other earned income, taxable income. And if we can get that into super, that is a reason why non-concessionals are really attractive to do. And obviously we use those a lot, particularly when people are selling assets such as farms and so on. So we use them a lot.
Yep. And it's always just remembering that that money is still invested and it's your money still in super. It's just in a much better tax environment.
Yeah.
So why not?
Yeah. So when you put that, let's say that term deposit example, the 470,000 can come out of term deposits and go into the super fund into term deposits.
Yeah, exactly.
Same apple, different tax structure.
Yeah. Instead of taxed at, that 34%, 15%, save 19 cents on every dollar. Yes, please.
Absolutely. Now, for those that are over age 67, if you want to make a concessional contribution where you're putting some money in and claiming it as a tax deduction, you still need to meet the work test. Things have become a lot more flexible when it comes for non-concessional. All the way up to age 74, you don't need to meet the work test.
Yeah.
But if you want to have a personal contribution where you get a tax advantage, you need to meet the work test. What's the test, Amy?
The test is making sure that you, in the financial year you've done the contribution, that you've had 40 hours of employment in 30 consecutive days. So it's not just, one day and then, I've met the work test because I worked one day. You've got to have that 40 hours over a period of 30 days.
Yep. Fantastic. There's a few work exemptions, and that's where I think where you've satisfied the work test the year prior, you can then make a contribution the following year, but your total super balance needs to be less than 300 grand.
Yeah.
It's probably one that I haven't really seen used in practice terribly much.
No, normally when you're, our age, 67 and older, you've probably got a little bit more than 300 grand maybe, and you're either working and can do that, or you're in pension phase and you don't want to do that tax deduction anymore.
Need to.
Yeah.
Let's talk about the co-contributions. Now, this has been about since Costello and Howard were obviously in charge of the country, and that's where put some personal non-concessional super contributions into superannuation, and the government will throw in some money for you. And at one time, if you put $1,000 into your super and you will look below the threshold, they would give you another $1,000. So it was 100% return on your money. And then in a few years, retrospectively, they didn't tell anyone at the time, but for those that put in $1,000 and they got $1,000, they gave them another $1,000. It was 200% return, no risk.
That's brilliant.
But things have changed.
Things have changed.
Talk to us about those changes, Amy.
So they still will give you a little bit of money, but now it's, if you're earning under $43,445, if you put $1,000 into super, they'll give you $500, which is still great. But after hearing the $1,000, it doesn't sound as good.
Let's reword that so the glass is half full.
Yeah.
It's still a 50% return on your money.
It is, and that's, as we always say as financial advisors, we can never guarantee returns because we have no crystal ball. But when it is the government co-contribution, that's a guaranteed 50.
Yep. Fantastic. So that cuts out for this financial year at about $58,500. Once your income is above that, that's where, you're not eligible for the co-contributions.
Yeah.
Yeah. One other key point is that 10% of or more of your total income must come from some type of employment, including self-employment. So we're not talking about people that are fully retired receiving passive income.
Yeah, you do need to have some gainful employment.
Yeah. Now, this is one that is generally not used terribly much. It's the spouse contribution, and that's where you're making a contribution on behalf of your spouse who is earning less than $37,000, and you can claim a tax offset of up to $540.
Yeah.
So
that, if we're talking about percentage terms and returns, that's 18% return. It's just that this return isn't going into your superannuation, it's a tax deduction, so you're paying less tax.
Yeah, so that is encouraging, it's a government encouraging us, another carrot, to put extra money into your spouse's superannuation, who's clearly earning a lower amount due to part-time work, family and other commitments. But again, 18% return, it's guaranteed, is again low-hanging fruit.
Yeah, definitely.
Easy wins, if you've got the cash flow to do it.
Yeah. All right, another contribution that we
Yeah.
can do into superannuation is the home downsizer. So this one is available to Australians that are over 55 years old and they want to downsize their principal place of residence, so their homes. If you're getting to 55 and you think, oh, I don't need this lavish mansion anymore, I'm going to give it to someone else, you can sell it and put up to $300,000 of the proceeds of that sale into superannuation.
Awesome.
Each.
Now, a couple of key points is that the downsizer contribution must be made within 90 days after the settlement of the property sale, and you need to have owned the home or your spouse for 10 years or more before the sale.
Yeah, and I probably should actually reiterate what I just said. It doesn't actually have to be $300,000 from the proceeds of the sale itself. If you sell your house and you only sell it for, I don't know, $200,000, but you have $300,000 in cash that you want to get in super, you can use that $300,000 of cash. You just have to have sold your house around the time that you do the contribution.
Great. So, and there's no upper age limit on this one.
No.
It's the one time where above age 75 you've got the option to put money into superannuation.
Yep, it's brilliant.
Great. Another one that is really not used terribly much, but I think is underrated, and that's superannuation splitting.
Yeah.
Amy, you want to tackle that one or
Sure.
go for it?
So superannuation splitting is when you want to split your concessional contributions to your spouse. Now the way that you do it is you do the concessional contributions into your own super fund and then submit a super splitting form in, and they will send up to 85% of the money you put in to your spouse's super.
Yep, fantastic. Now, you're unable to do that if your older spouse is age 65 or has met a condition of release.
Yeah.
So a condition of release is getting to preservation age, which is nearly for everyone. I think when we roll over at the end of June is 60 years of age, and if they're not working, that is a condition of release.
Yep.
So that stops the 45-year-old spouse putting money into the 60-year-old spouse and getting access to it straight away.
Yeah.
Now, why would we do this? Well, I think the first thought the government had was about evening out the balances of between spouses. But the other way you might do that, reason you might do that is you might transfer up into the older spouse's name to get earlier access. And on the other side, if we're talking about superannuation and the ability to get more Centrelink, we might split down to make sure that there's more superannuation assets that's exempt from Centrelink, from the assets test when it's held within superannuation in the accumulation mode.
Yeah.
Cool.
Even though this one's not, a guaranteed contribution by the government, it's still a great incentive to be able to get potentially more Centrelink benefits.
Yep. Now, here's one that came in many, many years ago. This is transition to retirement, TTR. Now, I think I can't remember what years, it was early 2000s, and it was a really attractive strategy. It was attractive because once you went to a transition to retirement, you could get up to 10% of your money out. The pension was tax-free within the fund, and tax-free on the pension paid out once age 60 and above. What changed was the tax rate within the fund.
Yeah.
Was zero, like a normal retirement pension is, an account-based pension that we mentioned earlier, but that's now taxed at 15%, the same as accumulation.
Yeah.
So it's not quite as attractive from that point of view, but why might it be attractive, Amy?
Well, it still is attractive because it allows you to continue concessional contributions into super and frees up your cash flow by being able to pull out that up to 10%.
Right, so it puts you in a position where if you say, right, I'd like to put in, say for this year 27.5 or next year 30 grand, I want to max that out and save tax, but I don't have the cash flow to do that because I've got to live and have fun as well.
Yep.
Getting some money from your transition to retirement superannuation pension can help you do that.
Definitely.
Yep, fantastic. So that is definitely one worth looking at. The reason why the government brought that in many years ago was for people that were working, full-time 5 days per week. They wanted to encourage people to be able to ease on into retirement and hopefully work longer.
Yeah.
So going from 5 days to 4 or 3 and supplementing their income with a superannuation pension, called it as a transition to retirement. But as the industry, our industry, we come up with strategies of ways and means to how do we benefit the clients financially. So sometimes it's used for different reasons.
Yeah.
Now, yeah, something to think about. This is for the particularly, really mostly retired people
Yeah.
or people that are age 65, working or not. So if you're between 60 and 65 and you are retired, you can think about this strategy. And for those that are 65, working or not, this is a strategy to consider. So we're talking about a recontribution strategy. Amy, why would we think about this strange strategy?
This one is mainly, it's not to benefit, us as the people with the super, but more so our kids and an inheritance point of view.
Right.
So with your superannuation, it has two components inside it, a taxable and a tax-free component. They're the two most common. There are some special untaxed elements if you have worked in a, emergency services or something, which are quite old, but...
Cool. So just let's go back. So we've got taxable and tax-free. Now, we mentioned concessional and non-concessional.
Yeah.
So just to try to make it as simple as possible for people, so a taxable component within a super fund would relate to concessional contributions where there's been a tax advantage, and tax-free money would more so represent the money that was non-concessional where there wasn't a tax advantage on the way in.
Yeah,
Is
so
that a nice way to think about it?
Yeah,
Yep.
it's tax-free. They're talking about these components on the way out. So tax-free components on the way out are ones that have their tax paid already. So the concessional contributions, because
Yep.
when you put that money in, it was taxed at 15%.
Yep.
So when you take it out, it doesn't need to be taxed again. Whereas the non-concessionals went in tax-free. So when they go out, they're taxable. So you just flip it. If it's been taxed on the way in,
Yep.
it is tax-free on the way out.
Yep. And what we're saying here, I think when money is going to spouses, it is tax-free. It's not an issue.
Yes,
It's
this
when it
is-
goes to non-financial dependents. So I normally start to think more deeply about this when the money is going to children. And when I've got a widow or widower in the room, and the money then has to go to the beneficiaries
Yeah.
who are not financially dependent.
Yeah.
Money going to spouses is always tax-free.
Yeah.
But that money from the non-concessional, which makes up the tax-free component, that will come out tax-free to everyone. It's that concessional, which makes up the taxable component, where there's up to 17% on it.
Yeah.
Yep. And if there is any insurance of that untaxed elements, which you won't see much of,
Yeah.
that's where it can be up to 30%.
Yeah.
Yeah. So that's one. Obviously, we've highlighted who that's important for,
Yeah.
and one to think about.
Yeah, and I guess the reason why we look at it more so for the elder Australians, because it is a little bit more likely that, both pass away within a short time frame of each other, and
Yep.
it's less time to do this strategy
Yep.
because you are bound by the non-concessional caps for that one.
Yeah. So, and the strategy is, as it sort of sounds, recontribution strategies. We take money out of super to get it back in based on obviously the contribution limits, the non-concessional contribution limits at the time. So this is something that can happen over, a decade.
Yeah.
Fantastic. Amy, I think that's about it. That's all we probably need to cover today. Is there any other areas that you're thinking about?
No, I'm just trying to think end of financial year, what are things that I make sure I need to get done, but I think that's it.
Yep.
Get the contribution in on time. Don't stress out your professional people. Don't stress out the accountant or the advisor by leaving it to the last day. And then you've got up until you lodge your tax return to put that notice of intent to claim in.
Cool. Grandparents that have got, stuck for presents for young adults that might be working part-time and doing a tax return, throw $1,000 into their superannuation fund. If they're earning under 43 grand, put $1,000 in as non-concessional, a present, and the government will chip in another present of $500. So that's probably, I don't know, you think about an extra, $1,500, compounding interest over the next 45 years or 40 years. Unreal.
Yep, and I think that's a strategy that you want to do the numbers on and get that compound interest calculator out, because saying it, and especially just saying it to the kids when they don't have access to super for, 40 years, they're not going to be that interested, but show them the figures and hopefully that gets them a little bit more excited.
Absolutely. Thanks, Amy.
Thank you, everybody.
Cool. Thanks for listening to us, and we'll see you at the next one.
Yeah,
Cheers.
bye.
Bye.